Hey folks, buckle up because we're diving deep into the wild ride that's been gold and silver lately. Specifically, that shady overnight drive-by shooting in the futures market that's got everyone from backyard stackers to Wall Street vets scratching their heads. It's October 25th, 2025. Silver's hovering around $48.98 after dipping below $50 just days ago, and gold clawed back from a brutal $100 smackdown. But don't let the headlines fool you with their tidy profit-taking spin. Now, this was a coordinated paper dump straight out of a thriller novel, timed for when New York traders were snoring and liquidity was thinner than a politician's promise. I'm talking shock and awe tactics that flushed prices, triggered automated sells while folks slept, and let big players swoop in to gobble up the dip, possibly covering shorts or loading physical at fire sale prices. Stick with me for the next 10 minutes as we unpack the what, the how, and the sneaky why behind this mess, drawing from frontline intel like Michael Lynch's razor-sharp breakdowns on Substack and X. If you've been riding this rally or eyeing a stack, this could be the wake-up call that saves your portfolio from the next engineered dip. Let's break it down. No jargon overload, just straight talk. First, rewind a bit to set the scene. We've been on an absolute tear. Gold and silver didn't just creep up, they blew through key levels like a hot knife through butter. Smashed past $2,000, never looked back. Obliterated $3,000 without a whimper. Even $4,000? History. And silver? It's been tagging along, hitting that wild $54 peak earlier this month before the rug pull. We're seeing $50, $70, even $100 daily swings to the upside. Unprecedented fireworks that have the mainstream scratching their chins, calling it overbought and due for a breather. Fair enough, some of that's legit. Markets can't sprint forever without catching wind. But here's where the narrative cracks. Ignore the how this pullback hit, and you're swallowing half-truths. On the night of October 2021, right in the dead zone between Asia's close and London's yawn, when COMEX liquidity is basically a ghost town, someone or some coordinated crew unleashed a tsunami of futures contracts. Boom! Silver plunges under $50, gold craters $100 in minutes. This wasn't your grandma's profit-taking, it was a precision strike, dumping massive volume into the thinnest trading window imaginable. Any half-decent trader knows that's suicide. You'd get fired, tarred, and feathered for tanking your own execution price. Spreading it out over New York hours, that's how you maximize returns. This? Pure theater, engineered for maximum chaos and minimum pushback. What happened next is the plot twist that screams, foul play. Almost immediately, within minutes, buyers piled in, shoving prices right back up. Silver clawed to green in under 30 minutes. Gold recouped half its losses by dawn. Was it physical demand roaring back? Shorts covering in a panic after the paper price got artificially crushed? Lynch, that eagle-eyed market sleuth over at Econ Analytics, calls it crystal clear. This was an engineered crushing by the paper shorts, with footprints leading straight to heavyweights like Bank of America and Morgan Stanley. These aren't sleepy retail punters. These are the big dogs who flipped from net sellers to vacuuming up ounces like it was Black Friday. Check Lynch's October 22nd. Substack drop. He's got the COMEX data dissected, showing record physical buys offsetting the paper flood since the roller coaster kicked off on the 17th. And get this. Since that date, over 6,000 new immediate delivery contracts have been inked, nearly a record for this late in the cycle. If the pace holds, we're staring down one of the biggest delivery months ever, rivaling February and March blowouts. Meanwhile, 11,000 paper-long contracts got vaporized. It's like the market got bombed in the dead of night. Then the cleanup crew showed up with wheelbarrows of cash. Suspicious? Understatement of the year. All right, let's demystify this paper dump thing without the trader lingo, because it's the key to why this reeks of coordination over coincidence. Picture futures markets like COMEX as a giant casino where paper means bets on price. IOUs, not the shiny stuff in your hand. Shorts, bets prices fall, have been piling on for years to cap rallies, but when they flood the board with contracts during off hours, say that eerie gap. Post-Asia, pre-London, when New York's fast asleep and bids are scarcer than honest politicians, It cascades like dominoes. No liquidity means one big seller steamrolls everyone. Prices crater on zero volume and poof. Silver's sub $50, gold's bleeding. Why not wait for prime time? Because in thick trading, you'd get filled at fair value, maybe even spark bids that buoy the price. This way, you engineer the worst settlement possible, spook the algos, and trigger a chain reaction. Those black box trading bots in hedge funds, they're programmed with stop losses. If silver breaches $50 or gold $2,700, they auto-dump to limit pain. Lynch nails it. While you and I were dreaming of moonshots, these triggers flushed retail positions overnight, handing the dip to insiders who knew what was coming. It's not trading, it's theater. Suppression with an ulterior motive, like knocking the price low enough to reload cheap or cover naked shorts before the physical squeeze bites harder. So, what's the agenda here? The effect? Rattling the cage, plain and simple. Flush out weak hands. Those over-leveraged retail folks who've been piling in after 9 straight weeks of upside that freaked everyone out. I've been hearing it firsthand. Business is booming. Stackers from Aruba vacations to Midwest garages are accelerating buys, catching mainstream eyes like Reuters and Bloomberg, finally shining spotlights on gold's glow-up. Maybe that's too much heat for the powers that be. Or flip it. With central banks hoarding like it's Y2K, nothing's changed on that front, supplies tight, debt wars rage, money printers hum. Perhaps it's margin call desperation in London's stressed vaults, or U.S. fragility bubbling up amid government shutdown whispers and repo market jitters. The UK's even side-eyeing our bank's wobbles. Heck, could be the Fed's rate cut tease or Trump's tariff thunderclap spooking shorts into covering. Lynch points to Morgan Stanley's CIO ditching the sacred 60-40 stock bond split last month for a 60-20-20 remix. 20% gold, baby. And BOFA's top dogs like Michael Hartnett preaching a balanced 25-25-25-25 portfolio with gold as the anchor. BOFA just hiked their silver target to $66-$67 next year, averaging $57 meantime. These aren't conspiracy whispers. They're institutional blueprints shifting to metals as the ultimate hedge against fiat folly. Whoever orchestrated the dump, they benefited. Scooping 196,200 ounces in 3 days by Lynch's tally. Flipping the script from sellers to saviors. Zoom out, and the mainstream's got a point. Yeah, rally's cool. Overbought signals flashed since late August, and a step back was due. Gold's off the overbought ledge now. Silver's confirming that 200-day uptrend without lower lows, bullish as heck. Silver's already flirting with oversold territory, screaming rebound potential while gold might dip a tad more before joining the party. Fundamentals? Ironclad. Industrial silver demands devouring 677 million ounces yearly for solar. EVs, AI chips, mine output's flat. ETFs slurped 95 million ounces in H1 alone. Deficits for the 5th year running. Gold-silver ratio at 79.1 begging for convergence. But to chalk this sell-off up to normal profit-taking without calling out the midnight mechanics? That's lazy journalism, peddling half the story to keep the illusion spinning. Real traders spread sells over days and liquid hours for max gain. This was antithesis, done for effect, to cascade fear and flush the little guy while whales feast. Bottom line, friends, this drive-by wasn't random. It was a symptom of the rot, the paper empire cracking under physical reality. With COMEX backwardation stretching to 2028, lease rates at panic 39%, and deliveries exploding, the manipulation game's on borrowed time. Central banks keep stacking, de-dollarization via BRICS hums, and economic storms brew. U.S. shutdowns, repo creeps, inflation stickiness. Gold and silver aren't just rallying, they're revaluing as trust in the system evaporates. If you're not stacking physical yet, coins, bars from trusted spots, now's the dip to dollar cost average before premiums spike. DIOR chat a pro, but don't sleep on Lynch's feeds for the raw data. What's your read? Was this a flush or a fix? You buying the rebound or hedging harder? Drop it in the comments, smash like, if this peeled back the curtain for you, and subscribe for more no BS dives into the metals matrix. Let's stack smart and ride this wave. You with me? Catch you next time.